Hey everyone, welcome back to Corporate Decoder, the place where we turn boring financial documents into juicy insights, and we've got a doozy for you today. We are diving into a filing from the BlackRock Private Credit Fund, and let me tell you, this one has some interesting tidbits about how they operate and what they're paying out. Alright, so what we're looking at here is what is called a Form 8, a current report that companies file when something significant happens. Think of it as a heads up to investors about important news. For the BlackRock Private Credit Fund, the big news revolves around sales of their shares and how they're dishing out money to their investors. The report is dated the 20th of October 2025, so we're looking at very recent events here. Now this fund, it is set up in Delaware and it has got a pretty hefty IRS employer identification number. But let's skip the bureaucratic details and get to the meat of it. This filing is from BlackRock Private Credit Fund, which is a company that invests in private credit. Basically, they lend money to companies that aren't typically traded on public stock markets. This type of investing can offer higher returns, but it also comes with higher risks because these deals are usually not as transparent as public investments. Now here is where it gets interesting. The fund sold some of its institutional class common shares. These weren't sold on a public stock exchange. Instead, they were sold to what they call feeder vehicles. Think of these as special investment pools primarily set up just to buy shares in this fund. This is a common structure in the alternative investment world. They sold over 1.10 Uniline shares in this private offering for a total of over $Uniline. This sale was exempt from the usual registration requirements under the Securities Act of 1996. This means they did not have to go through the lengthy and expensive process of registering these shares with the government securities regulators. They relied on exemptions like Section C(r), which is for transactions by an issuer not involving a public offering, and Regulation S, which deals with offers and sales outside the United States. This is pretty standard stuff for these types of funds, but it means these shares are not readily available to the general public. The fund also mentioned they issue shares to these feeder vehicles through their distribution reinvestment plan, which means investors can take their earnings and automatically buy more shares. Next up, we have a very important piece of information, the Declaration of Distributions. This is how the fund shares its profits with its investors. On the 24th of October 2025, the fund declared a distribution for all classes of its common shares. For the institutional shares, the gross distribution was $0.1966 per S-share, and since there were no shareholder servicing or distribution fees, for this class, the net distribution was also $0.1966. This is the actual amount that goes directly into the investor's pocket, or gets reinvested. For Class S shares, the gross distribution was the same $0.1966, but there was a shareholder servicing and/or distribution fee of $0.0170. This left a net distribution of $0.1796 per S-share. So investors in Class S shares received a bit less because of these fees. Then we have Class D shares also with a gross distribution of $0.1966. These had a much smaller fee of $0.0050, resulting in a net distribution of $0.1916 per S-share. So Class D shareholders got a bit more than Class S shareholders, but less than the institutional shareholders. The key takeaway here is that different share classes can have different fee structures, which impacts the total return for investors owning those shares. These distributions will be paid out on the 26th of November 2025 to investors who own shares by the end of the day on the 30th of October 2025. Investors can choose to receive this distribution as cash or have it automatically reinvested back into more fund shares if they are part of the fund's reinvestment plan. Now let's talk about the fund's performance as of the 30th of September 2025. This is where we see the value of the fund's investments. For all three share classes, institutional Class S and Class D, the net asset value per S-share was exactly $24.07. This indicates that, as of that date, the underlying investments of the fund were valued consistently across all share classes after accounting for any applicable fees that might affect the NAV calculation if they were applied daily. It is pretty neat to see all classes holding the same net asset value. Per share, this suggests a very equitable valuation process for the fund's holdings as of that specific date. And finally, we have the signature block. This is where an authorized person from the fund officially signs off on the report. Here we see Eric L. Keller, the Chief Financial Officer and Treasurer, has signed this report. This means he is certifying that the information within this filing is accurate to the best of his knowledge. It is a formal confirmation that the company stands by the disclosures made. So what is the story here? BlackRock Private Credit Fund is engaging in private placements of its shares, primarily with dedicated feeder funds. This is a strategy to raise capital efficiently within the alternative investment ecosystem. They then distribute profits to their investors with varying net amounts depending on the share class due to differing fees. The fund's net asset value appears stable across its classes as of the reporting period. Looking at this from a strategic perspective, BlackRock Private Credit Fund is clearly operating within its niche of providing private credit. The use of feeder vehicles is a common and effective way to pool assets for these types of investments. The differential in net distributions between share classes is a normal consequence of tiered fee structures designed perhaps to cater to different investor needs or investment thresholds. It highlights the importance for investors to understand the specific fee environment for their particular share class. The consistent NAV across classes on the 30th of September is a positive sign of a well-managed and transparent valuation process on that date. However, a key risk to consider with any private credit fund is liquidity. Since the underlying investments are not publicly traded, it can be harder and take longer to sell them compared to public securities. This means investors in this fund might not be able to get their money out as quickly as they could from a public fund if they needed it urgently. Also, while the report shows a stable NAV on a specific date, private credit valuations can be more subjective and prone to volatility, especially in changing economic conditions. Investors should always be aware of the potential for fluctuations in value and the inherent risks associated with private markets. In conclusion, BlackRock Private Credit Fund is operating as expected within the private credit space. They are successfully raising capital through private placements and distributing profits to their investors. The tiered fee structure impacting net distributions is a standard practice. The main areas for investor attention remain the liquidity of the investments and the inherent risks of the private credit market. Alright, that is our breakdown of the BlackRock Private Credit Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Do you invest in private credit or similar funds? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord in the description where we discuss these topics and more. Thanks for watching. See you next time.